Here's the uncomfortable truth that nobody is talking about when it comes to finance. Half of Americans approaching retirement have nothing saved. Zero.
Nearly 57 million Americans work for an employer that does not offer a retirement savings plan.
What did you think you'd be doing at 66?
Oh, I would hope to be retired.
And the other half, they've got about $240,000, which sounds okay until you realize that only covers about $800 a month. $800 a month.
More than half of the people who are retired right now do not have enough money to be retired.
It's not really a retirement.
What is it?
It's working every day.
That's your reward for 40 years of doing exactly what you were told. Saving your 401k, diversify, buy and hold, don't take on risk, and now all of a sudden, you can't afford rent. So either the advice was wrong or the game changed and nobody updated the playbook, and in my opinion, I believe it's a combination of both. So in this video, I'm going to show you the wealth architect that the top 1% use, and it's not what your financial advisor is telling you. We're also going to uncover why traditional models are mathematically broken, why the wealthy never sell their assets, and the layered system they use to build wealth that compounds for generations. Now, if you don't know who I am, my name is Matt Jimenez. I've worked with some of the greatest financial entrepreneurs online, and I make these videos to pour into you guys everything that they've poured into me. The way most people build wealth is painfully simple. You earn money, the government takes a third of it, you pay for your life, and whatever's left over, you get to park in hopes that where you park it, it'll continue to grow. That's very linear in terms of strategy and compounding your wealth. But we haven't lived in that linear world since 1971. Look at this. The cost of living has gone up 6 times since we left the gold standard. 6 times. And it's not going up gradually. In fact, it's going up in a parabolic fashion. Now look at the money supply. This is the Fed's own data. Every cycle, it expands faster. The cost of everything is compounding against you. But if your wealth building strategy is still linear, as I spoke on earlier, which is earn, save, wait, you're basically just bringing a bicycle to a Formula 1 race. And unfortunately, that model, the math just doesn't work anymore. Now, most people watching this already know they shouldn't be saving in cash. You're probably buying assets, but here's the problem. You're probably spreading those assets horizontally. A little in your house, some in an index fund, and maybe a little bit in gold. And in today's world, you probably got a bit of Bitcoin and think that you're diversified, but structurally, it's still flat. You've got one layer of assets and every dollar is doing the exact same job. Let's put the numbers on it to show you what it looks like. The classic 60-40 portfolio, which is stock and bond portfolio, which is what most financial advisors default to, has an average return of about 6.9% annually over the last decade. Now, when we look at Ray Dalio, the all-weather portfolio is even worse. It's 5.6%. Meanwhile, the cost of living are compounding faster than those returns. So these safe strategies aren't as safe as you believe, and the real problem is the delusion. It's happening so slowly you don't feel that you're actually losing. You're just keeping up somewhat with the times. But keeping up is the problem because that's not how you build generational wealth. You need something that can compound. And this is exactly why Einstein said compounding is one of the 8 wonders of the world. He who learns it, earns it. He who doesn't, pays it. Hopefully I got that quote right. And if you don't believe me, there's a simple formula that will explain it very well. This is the rule of 72. What you want to do here is take 72 divided by your annual return. That's how many years it takes your money to double. At a 6.9% from your 60-40 portfolio, it'll double every 10.5 years roughly. At 20%, which is conservative for Bitcoin over a decade, that happens every 3.6 years. So let's start with $1 million, compounded at 20%. You go from 1 to 2 million in about 3.5 years, and then it goes to 4 million, 8 million, 16 million, 32 million, 128 million. And so on. That last double, that's 128 million gained in just 3.5 years, which is the same exact percent gain that made you that 1 million when you first started. And that's exactly why the wealthy never sell their assets. Selling breaks the compounding chain and eliminates the compounding effect to work for you permanently. Now, the real question is, if the wealthy never sell, how do they pay to live? Because they still need to buy a house, a car, and fund their normal lifestyle. Well, here's the answer. And this is the part that changes everything. They use their assets as collateral. So whenever you're with other people and they ask you,
when are you selling your Bitcoin?
Or any other particular asset, you could immediately assume that this person is not playing the generational wealth game. You see, in the old game, your exit strategy is selling. In the new game, there is no exit. You hold assets, borrow against its value, and deploy that liquidity into more assets, all without triggering a taxable event. Here's how it actually works. Say you have a home worth $1 million with $400,000 in equity. that equity is just sitting there doing nothing. It's dead capital. It has no potential. Whether you leave that 400K in the house or pull it out, the home still appreciates at the same rate. So you extract it tax-free because it's debt, not income, and then you deploy it. Maybe you put some into Bitcoin, some into the NASDAQ, and now you've got 3 assets compounding instead of just 1. And when Bitcoin appreciates, there's new equity there, in which you can borrow against that and deploy it once again. $1 is now doing 3, 4, 5 jobs at the same exact time. Your house growing at 5%, your stocks at 12 to 15%, your Bitcoin at 20%, your blended return is multiples higher any single layer strategy has. That's vertical stacking, and that's exactly the game the 1% are playing. Now, I already know what you're probably thinking.
That's leverage. It's too risky. What if the market crashes?
And you're right, there is risk here. But here's what nobody acknowledges. There's massive risk in not doing anything. 45% of Americans who retire at 65 projected to run out of money before they die. Not might, projected to. And that's half of retirees living in fear of going broke. So your safe 60-40 portfolio isn't protecting you. It's just failing slowly enough that you don't panic. Look at this chart. This is the S&P 500 adjusted for the money supply growth. In real purchasing power, your stock portfolio hasn't made a new high in over 25 years. That's the dirty secret of buy and hold. Same story with housing. Home prices track almost perfectly with the money supply expansion. Your house isn't making you richer. The dollar is just getting weaker. So yes, the layered approach has risk, but it's structured risk that you could manage. And the way you manage this is through liquidity layers. Think of it like buying a fortress. Layer 1, your operating buffer, which is enough cash flow to cover all the payments with room to spare. Layer 2 is emergency reserves in cash equivalent to the yield-bearing positions. Layer 3 is your collateral assets with accessible equity you could tap into if layer 1 and 2 get stressed. If you maintain at least 25% liquidity ratio across your stack, you're in a strong position. Below 10%, you're in the danger zone. The point isn't to eliminate risk. There's no such thing as that. The point is to choose the risk you can actually manage instead of the one that's guaranteed to have you bleed until it's too late. Let me show you what this looks like in real numbers. Let's say 2 people at the same starting point both own $1 million home with $300,000 in equity. Investor A does nothing, holds the home. In 10 years, their equity grows to about $929,000, which is solid. There isn't really any complaints there. Investor B activates that equity, extracts some, deploys it into Bitcoin at 20%, NASDAQ at potentially 12%. After 10 years, accounting for the debt, Investor B is sitting on $2.7 million. That's nearly 3 times more from the same exact starting point. The 20-year number is where it gets absolutely absurd. So let's look at it. 20 years out, Investor A has about $1.9 million in home equity. Not bad, he's doing fairly well, but Investor B, now he has $14 million, and they don't have to sell their house to access any of that equity. Same starting point, same decade, just added 2 extra layers, and that's the separation. If you pass that system onto your kids, they keep that stack running, that's when you start talking about real generational wealth, not a paid off house and a prayer. Now I want to be very clear. This is not a Bitcoin video. This isn't a real estate video. This is about architecture for your portfolio. It's about disguising a system where your wealth works for your life instead of selling your life to work for your wealth. In the old model, every dollar has 1 job. In this model, every dollar has 3 to 5 different jobs. And that compounding difference is what separates people who retire with $800 a month from the people who never have to think about money again. And the thing is, most people won't do this. Most people will watch this video, think it's interesting, and go right back to their 60-40 portfolio. Moral of the story, don't be this statistic. And this is why on this channel, I talk so much about algorithmic trading, because it is an alternative edge that is another layer that I have used inside my own portfolio to help me diversify to put my dollars to work. If you're interested, I made videos explaining exactly how my algorithm did last year. And if you're curious, down below in the description is a link. Go ahead and click it and find out everything you need to know and how you can start layering your portfolio. Thanks for watching.